Good morning, good afternoon, or good evening, traders, wherever you are. Today's module, we will basically discuss some very basic idea of what is trading and what kind of market we should trade, and what's the difference between the different markets, and plus some other very basic terminology of the trading. So before we start, the disclaimer for everyone to see it. And that disclaimer is as required from the legal point of view, and also that's all trading contains high risk, and no trading is recommended unless you are actually experienced trader. All material in this training, they are copyright to the K5 trading. So the first thing what you need to understand that's if you want to be a successful trader, then you need to actually understand that, first of all, you have to have some kind of commitment. Without any commitment, you cannot succeed anywhere. The commitment includes financial commitment and the time commitment. Financial commitment is which give you the baseline or basics for so you can move on. And the time is your time which required you to learn, understand, and actually do the trading. Once you ready to commit time and financial resources, then the next stage is an education. Education is very important. Without education, any trading without education is just like throwing a stone into the river and you think like it will catch a fish or something. The trading is not like that. You need to understand what markets you want to trade, what's the difference between the markets, how they actually works, and also like when you need to enter into the market, when you need to exit out of the market, how to understand the technical analysis, market fundamentals, and all those kind of things. Without any of this knowledge, trading is just simply a gamble. Because in the gambling, you just toss 50-50. That's if it's your luck, it's a good luck, then maybe you will win. If your luck is bad that day, then you will lose. So education is very important before you can do any trading. So after commitment, you got this education from your time and from your financials, and then you need a dedication. Without dedication, nothing can be achieved. If you can get 1,000 books, if you read the 1,000 books about the trading, you watch thousands of videos about the trading, you have the money, you have the time, but if you don't have a dedication, you're not going to achieve any single anything at all. So make sure the dedication is there, education you have achieved, or you have actually got some education on the trading, and you got the commitment. Once you got these three, commitment, education, and dedication, that three things will help you to see the market with very clarity. Once there is a clarity in the market, then your planning, execution become very easy. And then of course, every single trade you do, after that, you need to review the trade. You need to find out like what mistake you have made in the previous trade, so you don't make the same mistake again and again. So these are the key component: commitment, education, dedication, clarity of the market, planning the trade, execution of the trade, and review of your trade. Any of these things is missing, you are not a successful trader. So if you want to create your own success, then make sure you follow this path. This path will take you to the where you want to go. Especially, it will help you to achieve your financial goal, and it will actually free you from this financial slavery. Now we're going to go about the module 1, which is basic of the financial market trading. First of all, you need to understand it is not about you making money. It is about market maker's business. The trading is a market maker's business. They make profit. You simply follow them. You are part of their business. Now, which side of the business you want to be with them, a losing side or the winning side, that's your decision you have to make. But understand that you are not the market maker. This business model, or whatever the business model, which you call it the Forex trading or stock market trading or future trading, they are the business model for the market maker. And they got only one goal is to make the profit. To make the profit, they will do anything. they will actually dump the entire market, bring to the knee if they can make the profit that way. So you need to understand that's what the market maker want to do, and you just follow that path, and you won't actually regret for that one. So it's not about you making money; it's about the market maker's business model with a single goal of the profit, and you are part of their business. When you are part of their business, you have to decide which side of the business you want, the losing side or the winning side. So there are so many different kind of the financial assets in the market. Some of them are listed here, some maybe I'm missing. We won't go for each and every of those one, but we will go some very, very basic one. And we will spend more time on those financial asset class which we be actually trading. So the stock market, everybody aware of like what a stock looks like. A stock is a portion or is a share in a company of your investment. So if a company got about 50,000 shares and you buy about 10 shares, then you are 10% shareholder of that company or 10% owner of that company. If the company make profit, you will actually get the dividend for that 10%. If company lose money, then the value of your shareholding will actually lose. So it will decrease. So stock is the very, very fundamental things about the financial asset class trading. We normally trade in the US stock. We don't trade on Australian market for one very simple reason. The cost of the trading is very, very high in Australia. And the cost of the trading is high, and also the volume is very, very low here compared to the US market, where the cost of trading is very, very cheap. And the volume is there, and there are more actually varieties and the different kind of options you got available. So in US, if you trade in Australian market, the stock especially, then most likely that you're going to pay through the CommSec or NAB or these banks which actually got those platform available. They charge somewhere between $20 to $50 per trade. So let's say, for example, if you want to buy 100 share of, for example, let's say a company called BHP Bulletin, right? So you want to buy 100 share of BHP Bulletin. The cost of each share, if it's $300, so you pay that's 300 by 100, which is $3,000 or whatever. On top of that one, you will pay $20 or $50, whatever the commission your broker, which is CommSec or NAB, will charge you, and then they will deliver those stocks to your wallet or your portfolio or whatever, right? Now, let's say, for example, the BHP Bulletin market actually move on in 1 month about from $30 to $40. So in 100 share, you actually make $1,000 profit. If you want to sell it now, that's 100 shares, then it means that you have to go back to the CommSec. You tell them like, okay, I want to sell this one at this price. They will charge you again $40 or $50 or $20, whatever their commission is. So the profit you make for the $1,000, out of $1,000, you pay twice transaction fees, one for buying and one for selling. And if you just imagine, if you want to do this kind of activity on the daily basis for the stock in Australian market, how much it's going to cost you? And this is not that the CommSec or NAB are charging. The Australian Stock Exchange, the fees are quite high in Australia compared to the US. US, you want to buy, let's say, the 100 share of Apple, and the cost of each Apple share is about, let's say, again, $30. So $3,000 worth of the share you have purchased, and you pay the commission, which is probably 30 cents or 40 cents to your broker. And that's it. So when you buy, when you sell it, if you want to buy same day and say you want to buy in the morning and sell in the afternoon just to capture the daily profit, your commission is only 60 cents compared with the $60 in Australia or whatever. Another good point you need to understand about the US stock market, that's in the US stock, if you want to do a day trading, it means that's on the daily basis you want to buy and sell, then the minimum investment requirement is $25,000 US. If you don't have $25,000 US in a week, you can only do twice a daily trading. Twice you can buy and sell on the same day. Otherwise, you can buy today and you can sell next day. That's fine. The other class is a future options, Forex, CFDs. So I will cover a little bit about CFDs and those ones in other slides. I want to cover here something called ETF, sorry, not ETF, bonds, Sukuk, and binary options. So ETF is all about like, sorry, the bond is all about like the government treasury bond, which government raise the fund and they sell their bond into the market. People actually buy them, government pay interest on that one, or the maturity time, the prices go higher and the government buys them.
Is on make sure this one's well, no.
So the bond is actually the government issues treasury instrument where you actually make you earn some interest and you make some money when if the bond's prices actually move up or down. In this case, you will lose. Sukuk is the same as the bond. It's just the Islamic version where you basically don't earn any interest, but the government, if invest that money into some kind of project, and if they make some money up there or some profit, they will actually share that profit with you. Okay. There is a last one up here, real estate index option. So real estate index, they are US real estate markets option, and it's basically whatever the current value of the real estate index or ETF in America. Again, that's when there are option and you can basically simply buy a derivative. So it's a kind of a derivative. Binary options is gambling 100%. It's about to ban in America and it will follow with other countries as well. So binary, basically you simply bet with your broker on a particular stock or on a particular future or in a particular, let's say the indices, that the prices will go up or down. And based on that one, how many points you actually predict, your broker will pay you, or if it goes against by some number of the point, then it's actually take your money out. So it's just pure gambling. It's got nothing to do with any stock, with any indices. You don't own them. You don't actually sell them. It's basically just the gambling on the base of the price of those financial instruments. So now let's start with the the future. So future contracts are an agreement between producers and the buyer. So buyers and the seller. So producer is a seller and a buyer is a buyer. So for example, let's say a producer of the rice or a producer of the wheat, they actually think that their crop in about 3 months time will have some kind of the cost, maybe $2 or something per ton or whatever. But they need some money upfront so they can actually produce that particular crop. They have to buy the seed, they have to buy the different, whatever the instrument they need. So they actually goes to the Chicago Mercantile Mutual Market and they say, okay, I'm about to produce that many ton rice or wheat in that many months. Anybody want to buy that particular product when it's ready? People or the buyer will actually raise their hand and say, yes, I want to buy, but I can pay you only that much. So if the buyer thinks that the rice or wheat price in 3 months time will be $4 or $5, he can offer seller that, okay, I will agree with you on the $3 right now, and we lock in the contract. At the time of the delivery, I will actually get all the products and pay you whatever the balance is that. So a future contracts mean that someone, as I said, someone will buy something in the future, will take delivery of a finished product or commodity. The futures actually can happen on oil, any commodities. Some of the very common commodities which we normally trade is oil, wheat, sugar, cocoa, and also there is a natural gas, and there was another one, sugar is recounted. Yeah, so these are about 5 or 6 things we actually, and also the cattle, but we don't trade on the cattle. And there are some future options on indices like S&P 500 future or Dow Jones futures, NASDAQ futures. So we do trade on NASDAQ future. We do not trade on S&P 500 and the Dow Jones for different reasons. But these are the future contracts we actually trade. So now I'm giving you another example of a future contract of the NASDAQ. Let's say, for example, Today, the Nasdaq price $26,000 per share. In 3 months' time, I am anticipating that this particular Nasdaq share will actually, or this future coin will reach up to maybe $30,000. So I will buy a future contract of that Nasdaq for 28,000 or 26,000 or whatever the price market in the market at that time. I will buy that future contract. I will hold that one with me. And during this 3 months expiry date, if the contract price is increased, I can sell that contract to somebody else. And that person will actually pay me my the difference of the amount I paid and the difference of the price at that time. And I'm now finished with this contract. I make my profit. I move on. Now that contract is belong to somebody else. Prices keep moving, and people actually keep selling the contract between each other. And at the time of the delivery, when it comes, the final person who is going to take the delivery, he will look in the market and say, okay, how many contracts are available and what's the price? And he sees that the price of these contracts are actually coming for about maybe $28,000 or $29,000. He will buy that one. And then he will take the delivery, pay the full amount for that contract, paid the full amount and take the delivery. And maybe after 2 months, he will sell that Nasdaq contract for $35,000 or $31,000 or $32,000. But he is taking the risk of getting the delivery of the full contract. It means that his investment in that contract is increased, and his risk is almost up there as it's required is in every trading. And he will take the delivery and keep it within the portfolio. Later on, he will sell it. So this is the one person. Other person in the other side, like when I actually purchase that one, or third person before me or after me is purchased that one, he only pay a portion of that contract price just to reserve that contract. And he promised that, okay, I will pay that much full amount at the time of the delivery. But before the delivery time, I actually sell my contract to somebody else. It means my investment was small and I make a gain on that investment, which is a little bit more than what I would actually made if I have to invest a lot. So if I have to invest $26,000 upfront for one stock, versus if I have to invest only $2,600 for one stock. So the difference between that one, the profit is actually more. And also I don't have to worry about the hassle of the keeping and taking the delivery of my goods. So that's very, very important. If I do oil trading, let's say, for example, one of the oil rig company, they actually who produce the oil, they want to buy some, they want to take, drill some more oil, but they need some financial assistance so they can cover their costs. They come to the market and say, yes, we got in about 6 months time, that much barrel oil we got for sale. Anybody want to buy? There will be a contract written on that one, and people will write the contract on the current price or whatever the price in the market, and they will put into the put into the exchange. People will see, yes, I can see there is some good move coming up on that one, so they will buy that contract. Once they buy this contract, they don't pay the full price at that time. They will pay only the small price of the contract. That's called leverage. And that leverage actually provided by your broker. So you pay a little amount, you secure your contract, and after 2-3 days, when prices move by another 10 or 15 points, you just simply sell it and you make the profit with the little amount, and you just move on, and that contract will move on until somebody takes the final delivery of the product. Okay, under the contract terms, seller and buyer have to agree on a product acquisition in the future with the following primary attributes. Number one, the fixed delivery date, fixed properties of the products, and the price. If these three things must be agreed before any contract can be signed. Traders normally do not take the delivery of the final product, but finance them. So as I just mentioned, how they finance them need experience and the thorough understanding of the future market, how the contract written, what's the leverage. If you don't know this one, please do not trade this. This is highly, highly risky trading. And without experience and understanding of this, the future market, it's not gonna work. The other one is another symbol is options. They are derivative of the stocks and is a cheaper alternative to the share trading. So Apple share is currently, let's say, $170. I want to buy 100 shares. So I have to spare $170,000 or $17,000. And if I don't have that much money, but I still want to own that one, I can buy the derivative of the stock. Let's say, for example, $2, $10, $15, whatever. And that's my only risk on this one. If I lose, maximum I can lose is a $10, right? It's a very complex system and we can't explain in 2 or 3 slides. You have to understand the difference between options and the future. Options where the future where you have to take the delivery of the product sometime in the future. In option, if you don't take the delivery of your stock, by that it will collapse and you will lose whatever the money you have paid. So it's in option, there is no necessity for you to get the delivery of the product. It's a very complex system. And it's a time decay can be your enemy or the friend. So for example, if you buy an option of 1 year time, the prices of the time decay will actually have an impact on the option price. It will decrease that one. So as it's moved to the closer to the expiry date, the time decay will increase. So if you are the seller at that time, time is your friend. And if you are the buyer, and then the time decay can be your enemy. So you have to understand this time decay. There is no pre or post market trading happen. It's only a certain when the market open, which is 9:30 until 4 o'clock, and that's it. You can't buy or sell after that or before that as you do in stocks. Okay, it's not a simple buy and sell. So it's a very, very complex again, and do not attempt to trade if you don't understand. We only use option trading when we see that the prices or a stock is in a wave 3 where we know that price is going to move up. At that time, we try to buy some options and make the profit as we move on. CFD. CFD is in concept to the option with the following differences. It's a kind of a spread betting. So whatever the difference between the bid and ask price, you basically bet on that one with your broker. Highly risky if not managed properly. No actual stock purchase or sales involved. 24-hour trading, it is a betting on the price of a particular stock or the instrument number. It's similar to binary, but a little bit different. That in binary, you got the binary options like A, B, or 1, 2, or 0, or 1. In CFD, you can actually buy something right now, you sell in the future. But again, the CFD is not the actual buy or sell of a stock or a product. It's just like you are buying something which is against your broker. Cryptocurrency. It's a new form of financial asset developed on the blockchain technology. One of the biggest problems, this market is highly unregulated, or is this totally unregulated. Exchanges, they are aware what they're doing, who they are, and their background. You don't know that one, and they want to know everything about you. So that's very, very risky. And the many cryptocurrencies are not based on the real technology or a new innovation. They basically just simply virtual currency people launch here and there, and then they can run away. Many of the ICOs who actually lodge the ICO, they collect the money, they fund, they close the ICO and move on to the new ICO. So people actually lose money on that one. Bitcoin was the first cryptocurrency in the market. The most popular are Bitcoin, Ripple, Stellar, Litecoin, Bitcoin Cash, and some others, which probably you can actually think of. There are thousands of those. The major issues are unregulated exchange around the world, high risk of the personal identity theft and misuse, highly speculative, banned in many countries, not a simple buy and sell, because you need to understand what the speculation going to do with you. We will discuss a little bit more in the crypto during the training. Okay, the primary indices are, we got a few primary indices, and an index is like a track index for multiple stocks. And some of those stocks actually, they pull fund in that one, in that particular index. Sorry, so people actually pull the fund in that particular index. That index actually invest in those companies which they listed in their index, and proportionally, whatever the proportion they have. And as they actually move on, they actually pay the dividend and distribute the dividend to their people who actually bought those share on those or stock on those indexes. Some of the famous indices are Dow Jones Industrial Average, one of the oldest in the world. It's contained the 30 companies of the US, which are heavyweight industrial and manufacturing and technological area. So some of the example in the Dow Jones Industrial Index is the AAPT, Amazon, IBM, Johnson & Johnson, Boeing, Microsoft are the few to name. Just see if I can try to find some of those, the listing. Okay, so now I can find, just 1 minute. So if we do here, let's say Google, and in the Google you can find Dow Jones Industrial Index average, and that will actually tell you how many companies are there. And these are companies. So these are the 30 companies in Dow Jones Industrial Average. And you can see these are the some very, very top name here: Triple M, AXP, American Express, Apple, Boeing, Caterpillar, Chevron, Cisco, Coca-Cola, Disney, DuPont, ExxonMobil, and General Electric, and so on. So these are the companies which actually part of this Dow Jones Industrial Average, and they normally quite high value companies. Yes, they go up and down, but on average, their prices actually move a lot from the day one until right now. So if I do actually another Google search here and say that's let's say 100 years historical chart of Dow Jones, right? So Dow Jones. Right. So if you look at here, that's very small. Okay, so this one makes sense. And so you can see that this chart is actually start from 1915, and it's gone right up to 2017 and 2018. So you can see that the prices at the time when it's launched first time, it was $2.50 somewhere around here, and prices continue moving up and up and up so far since then. Now it's looks like if the wave 4 and wave 5 is about to complete, and then price is going to collapse. So that's how you actually read the chart. So yeah, so that was one of those Dow Jones Industrial Average at 30 companies, currently trading around 26,000 or something each year. S&P 500, an index of 500 high performing companies in US. And these index consist of the 9 sectors. And those sectors are technology, finance, consumer service, healthcare, energy, public utilities, consumer non-durable, basic industries, capital good, miscellaneous, transportation, and consumer durable. So there should be something which we always interested in: the technology, healthcare, energy, and basic. This is not actually basic industry. This is basic material, and yeah, and durable, the stapler. So these are the ones which we normally trade on. So it's again technology, healthcare, energy, and basic materials, and the consumers durable. And yeah, so these are the one where I normally invest in these companies. You can actually, there are ETF for each of these sectors, and you can, rather than having trading or participating in the entire S&P 500, you can go just each individual ETF as well. Okay, NASDAQ Composite, Russell 2000, there are 2 other indices. They are very, very popular. And these are some indices you can see here, which actually mention up here: Dow Jones 30, NASDAQ 100, NASDAQ S&P 500, Dow Jones Composite, Transportation, Utility, New York Exchange, MX Composite, and all those ones. So this small cap 2000, these are basically Russell 2000, as I mentioned here. So now that's actually come to the next one, which is which market do you want to trade? There are many markets you can trade: Forex, most popular, stock, future, crypto, and other. And we go in each of those and see like what's the benefits and how you actually do it. So this is the percentage of the trading which I do on each of those ones. I normally invest my own portfolio or the company, the investment portfolio which I managed. I know I don't trade on the crypto on that one. I only trade Forex, stock, and the future. Forex normally consists of about 60%, and then 20% stock and 10% future and stock, sorry, and the 30% stock and 10% future. I do not trade crypto for my portfolio investment. I do trade crypto for my personal portfolio, but not the ICAP or KVT Trust or Dolmen Trust and those trusts which I manage. I don't trade crypto on that one. So majority of those I trade in Forex. Some of the benefit of the Forex is the leverage. If you know how to trade Forex and you understand those charts and you understand their market trend, it's very, very lucrative trades up there. Stocks, I only put about 30% of my portfolio into the stock. I normally try to maintain the stock which is high value, and those high value can be like currently, because the limited fund, I trade in Apple, I trade in Dow Jones, I trade IBM, I trade Amazon. So I have actually created a list of 150 stocks, which I normally trade. I develop this list every month, and then I pick up about 5 or 10 stocks from that list every week to trade myself on those stocks. I normally trade only US market. I don't trade anything else. And then it's come to the future. Future, my favorite is oil, wheat, and natural gas, and and Nasdaq. So these are the ones which I play in the future. How do you make profit from the trading? This only two rules appear, nothing else. Increase your probabilities and reduce your risk. If you can manage those things, as much as risk you can reduce and as many as probabilities you can increase, your trading will be very, very powerful and successful. We will learn in this course that's how we can increase our probabilities and how we can reduce our risk. So because these two things, the entire course actually consists on learning like how we can do these two things. Because if you can manage these two, all the trades are yours. Okay, how to make the money from the trading, profit from the trading. So these to increase the probabilities and reduce the risk, we develop few key points, like we need to understand fundamental analysis, we need to understand technical analysis, we need to understand risk management, and we need to understand our strategies or our trading plan, whatever we have devised. So these four things we need to understand, then we are able to actually increase our probabilities and decrease our risk. So another thing which you must understand, that you need to know your system and your trade planning. Learn your fundamental of your market, learn your trading software, understand your trading strategy, understand your trading plan and its direction towards your goal, understand market technical and its terminology. What's the order type? How many order type? How do you put, like you want to put the market order, you want to put the limit order, you want to put the stop order. You need to know all of these, and you also need to understand like when you want to put the limit order, when you want to put the stop order. You also need to understand that those order types, they are different. Their definitions are different in each market, and each trading software, they treat it differently. So you need to make sure you understand all of those. You also need to understand how you can read your chart and how you can find the gems in the market by scanning the market. So we will learn how to scan the market as well in this course. It's all dependent on how much time we have. If we run out of the time in 2 days, then probably we have to continue our learning path in our online session. These are the few of the market scanner you can use. I normally use the Finviz, and I will show you like how I use the Finviz. It's a free software, a free website. Everybody can use it, and anybody can use it, and it's one of the best tools I have ever seen for the scanner. Right. So we are in this site, Finviz, and the way I scan my market is I go up here, scanner. For some reason, it's running a bit slow. Right, and you click on all technical indicators, and then you select your country. So currently what it's got 7,146 stocks. And my goal is to reduce this list by most likely 100 stocks or 150 stocks, a max, for this month, which I want to trade, right? So I'm just going to create now that list in front of you, so you know that's how I do it. Okay, so I only want to choose the stock which are US based. Now it's reduced already, get out 1,000 stocks. So that's one good thing. My price range is between, let's say, over $10. I don't actually trade on those cheap stock, which doesn't give you much profit. So 5,000 now. Okay. Another thing which I want to do, I want to make sure the volume of each of the stock is at least 2 million or over 2 million. $512 stock now. Wow. So this is how you actually can filter out all those the stock which got no value. Many of the people actually, they do on the daily basis about less than 2 million, but this is mine. So if I do 1 million, then you will see that it will actually increase from 512 to something else. But I use 2 million. So Finviz looks like it's maybe running a bit slow at the moment. Okay, so let's leave it here for 2 million at the moment. And we move to the current volume, which is, okay. Let's do the current volume, which is now, again, if you want to do it 2 million, that's fine, over 2 million. If you don't want to do it, then you can go a little bit lower. So now I got only 463 stock from 7,000. All I need to do now, I need to see that's what kind of market I'm looking. So I'm actually looking those stock which actually going to move higher. So they make some kind of pattern, which I am actually interested. So here you can see here a pattern. And these are the patterns. So horizontal support and resistance, no, wedge up. That's mostly wave 5. So I don't want that one. Wedge down, that's normally wave 5 on the downside. So I'm interested on that one, but we will go in a sec. Or I just want to see only the wedge, or I want to see the channel double bottom, let's say. I want to go on the double bottom and double top. So double bottom, most of the time, it will actually highly valuable stock which will go up in the near future. So let's see how many there are. Only 9 companies who have a double bottom, right? That's fine. I'm actually good on this one. And all I'm going to do is I'm going to see here, click on this chart. And now I can see all those 9 charts, and I see like which one make actually sense to me. So this double bottom is already gone. So it's too late. This one, ALK, it's the price is coming down. There's one bottom, one, and I think the price is going to move up. So these kind of stock, which maybe I'm interested, because I can see here this price is move between the channel, and if it's reaching its channel and there it's going to be actually go up, then that's kind of market I'm interested. AGN, this is another one, and it's a drug company, so maybe that's coming down and then it will go up. So I will actually put this AGN in my list to monitor. The other one is Direction Daily Gold Miner Index bear 3 times. That's actually quite good. I actually made some good money on this one, so I have to check that one. DUST, and another one is this one, United Continental Holding. That's actually dropping down a lot. So I need to actually analyze what kind of trend is this one, and maybe there is some trades coming here soon. Maybe not today, but maybe after 2 weeks. So UAL, and what else I got here? This one, no, not interested with communication, and I can see the big gap here. So no, sorry. This one is Skyworks solution that's also creating a kind of engulfing pattern or some inside bar here. So maybe the price is going to go down again and then it will go up. So that's not interesting. This one, 1, 2, 3, 4, 5. So the PC. So this one is PAH. That's could be a potential trade for the, maybe not this week, but next week. I need to check in again. So this is how I actually do my scanning through these free software. I also do my scanning through another software which I have, which is Motive Wave. It's about cost $1,500 US, and if you want to buy that one, you can buy that one. But if you're looking for the free tool, then the FinViz is one of the best tool available. Here I normally have those scanner as well, and those scanner will actually search for me whatever I want to search a particular time. So at the moment it's searching for E-waves into all the stocks, also not all the stocks, all the currencies, but I have an option to do the scanning for the stock as well. I normally upload my 150 or 200 stock list into this system and then let it scan for every day and tell me what to buy, what not to buy. But to start with you for the free software, I think this FinViz is more than sufficient. There are some other software like investing.com and tradingview.com as well. They will give you some information, but I didn't find as good as this one. So no. And here you can see that they got a scanner as well somewhere. Crypto market. More social trending. No, they don't have a scanner here. So barchart.com, they do have it. But one good good information, they have a broker blacklist. So when you sign up with some broker, these are the ones you don't want to sign up. Okay, right. So these are the tools, you can use it, and investing.com, tradingview.com, they got all the data, you can analyze your market there. Now we come to the trading toolbox. So your trading toolbox it's not limited to what you can see on the screen. This is just like in your toolbox, you should have something to understand the fundamentals, like how the money is actually flowing in a company or in a country or in a region. You need to see the news items. You need to see the interest rate of each of the country in case of the Forex. In your trading toolbox, you should also have candlesticks and candle signals as well. So you need to understand candlestick, single candle pattern and double candle pattern and triple candle pattern. You also need to understand the price action. Price action is very broad term, and it means that you need to understand how the market actually moving and what could be the next. So the pattern analysis is actually a part of the price action. Candle analysis is part of the price action. Any technical analysis tool which you put up there, they actually confirm the price action, or they will actually give you some direction which way the price actually going. The mathematical indicator, they are based on the price, volume, open, high, low, and other parameters, and they try to draw some kind of indications on your chart, and some of them like a moving average, Bollinger Band, your Kettner channel. These are all mathematical indicators. We only use moving average, we use stochastics, and we use some MACD or awesome oscillator. We don't put too many indicators on the chart, because if you have too much indicator on the chart, you will get confused. You don't know what to do, and basically you will either lose the trade or you miss the trade. So minimum amount of the indicator in the chart is better. only thing you need to do, you need to get the confirmation of the price action. Many of those mathematical indicators, they are the lagging indicator because they actually calculate the thing based on the past history. Also, many of those mathematical indicator, they calculate differently the same thing. So for example, oscillator, all the oscillator, they will give you the similar kind of indication. So you don't need to use the 3 oscillator. Like if you are using RSI, you are using the stochastic, and you are using MACD, then there is no point. You just use one. Same thing, moving average. You got plenty of many type of the moving average. Simple, exponential moving average, simple moving average, weighted moving average. You just need to use one. Yes, those indicator doesn't work all the time. They actually behave differently on each stock, each forex currency, and everywhere. So the detail of those indicators, when we come to that one, they are actually kind of the personalities of each price and each the pair of the forex or each stock. In your toolbox, you should also have a risk management plan. Your risk management plan must be rule-based trading, and proper risk to reward ratio you should actually have in your risk management plan. So your risk management plan is your key tool in your toolbox. Your fundamental analysis report is a key tool in your toolbox, and the technical analysis report is also a key tool in your toolbox. We're going to stop this session here, and tomorrow we will have another session which will actually tell you understanding how the forex trading works. So we will stop this video recording here, and tomorrow I will post another one for the forex trading. We will cover the basic of the forex trading, then we will cover a basic, very basic of the chart pattern, and then we will leave. And most of the trading after that we will cover in our online our trading on 10th and 11th Feb. So I stop in my recording here, and if you have any question, post into the group and I will answer them. Thank you very much.